They are issuing bonds to pay the interest. That's paying your credit card with another credit card, and then giving it to your dad and say, well, you settle the bill.
Whoa.
Which is the Fed. So I think they completely know what's going on, and I haven't really shared this with anybody yet. I also think it's global and it's understood, and it's all smoke and mirrors, that we never saw what the game was. And I think I've proven it, that this is all the central banks did. This is what quantitative easing. So the only way to solve this goes back to our earlier conversation, is we cannot solve population growth, and debt growth has peaked out. So we've got the one thing in the middle called productivity, and that takes us right back to AI and the robots and cryptocurrencies, Internet of Things, green energy, all of these things.
According to Pal, debt levels across households, corporations, and governments have reached unsustainable levels. He explains that both American households and businesses are 120% of GDP in debt, while the U.S. government carries debt equal to 100% of GDP. The problem lies in the fact that the economy cannot grow fast enough to cover these obligations. With GDP growing at an average of just 2%, while debt continues to grow at a faster pace, most of the borrowed money is now being used to finance interest payments rather than stimulating growth. He likens this situation to paying off your credit card with another credit card. The U.S. government issues new bonds just to cover interest payments, transferring the debt burden to the Federal Reserve's balance sheet. This strategy, known as quantitative easing, QE, has been adopted by central banks worldwide. Pal argues that QE is essentially smoke and mirrors. Countries pretend they are not debasing their currencies, but in reality, they are injecting liquidity into the system to stay afloat.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Everyone's got a lot of debt. All the corporations in America, plus the households, are 120% of GDP in debt, and the US government's 100% of GDP in debt. All debt that the US has borrowed above GDP growth, so if GDP grows at 2% and debt growth grows at 4%, everything above is only for financing interest payments since 2009, since the recession. And so all of that money is the exact same amount as the size of the Fed balance sheet. So they are issuing bonds to pay the interest. That's paying your credit card with another credit card, and then giving it to your dad and say, well, you settle the bill.
Whoa.
Which is the Fed. So I think they completely know what's going on, and I haven't really shared this with anybody yet. I also think it's global and it's understood, and it's all smoke and mirrors, that we never saw what the game was. And I think I've proven it, that this is all the central banks did. This is what quantitative easing. And step back is what am I talking about in this scrambled nonsense that I'm saying? The US, for easy maths, long-term trend rate of growth is 1.75%, but let's call it 2%. Interest rates have been average around 2%, let's say, for easy maths. And the government is 100% of GDP in debt. So therefore, their interest payments are 2% of the entire GDP, which is how much the economy grows. Okay, put that over there. Oh, but you guys in the private sector, you're also 100% of GDP in debt. Where does your 2% come from? Because GDP is all of the activity in the economy, and that's just gone to the government. Sorry, guys, you're either going to go bust, or we're going to blow up, and you're going to blow up the banking system, or we're going to have to keep eating this negative growth difference of 2% every year until you get rid of this debt, and we're all fucked. So once you realize that these two pools are both 100%, you realize, okay, somebody is going to have to do something so it ends up on the Fed balance sheet. So when you go to Japan, really interesting, because Japan, the households are massive savers. Companies are pretty in debt, but the government's massively in debt. And it's the same, but because their interest rates are lower, they can have more debt. But their economy grows really slow as well. So you get to a certain point, and then you have to say, right, it has to go into the balance sheet. The Europeans have been doing the same. The Brits have been doing the same. It's all the same thing. It's like it feels that, and this is going to sound ridiculous, it feels like there was a global treaty of which, okay, this is where we are. We can't, the debt has got too big, and nobody can pay the interest payments without destroying the global economy. So we're just going to have to pretend we're not debasing the currency and call it quantitative easing and say it's a precise way of injecting money exactly into the right part of the financial system. And it's like, no, what you're doing is getting a credit card to pay off your credit card and then giving it to your dad and say, you worry about this, it's not my problem. It was rational to take the debt, and this is where we've got to. And then it was the government's got into the same boat and everyone was just the debt. So now the debt is the debt. Debt growth is actually not that high anymore because we've hit the ceiling. So the only way to solve this goes back to our earlier conversation, is we cannot solve population growth. And debt growth has peaked out. So we've got the one thing in the middle called productivity. And that takes us right back to AI and the robots and cryptocurrencies, Internet of Things, green energy, all of these things. So if you are governments, look what Europe's doing. It's interesting, and maybe I'm just inventing a narrative. But Europe, the US, Japan, they all know what they're doing. So they're printing money to cover their bills. And Europe thinks, well, Christ, we need to get the bloody economy going here because GDP growth is what pays our bills. And it's pretty sluggish because everyone's old here and everyone's in debt and the banking system's a mess. Let's do a double whammy, which is what the US did back in the 40s. Let's put as much stimulus as we can from this fake money and ram it into the green energy sector. And we're going to build a lot of stuff. And we understand a lot of stuff is going to be wasted capital, but out of it, we're going to do one amazing thing, and it will happen, is out of this, energy costs will collapse. Now, this is really important for people to understand. What does technology do? Technology drives more productivity out of a single unit of energy. It kind of, once you see this thing, it's like that's what humans do with everything. It's like find a way of extracting more for that barrel of oil, because that's what we use. Now, that barrel of oil has been our fixed energy source since we replaced whale oil. So we've been using this, and so it's been the constant. So technology's had to drive all the productivity in every way it can based on how much is this. So we've had to bring computational power down, everything down, so that one fixed thing, which is the price of oil, which on a inflation-adjusted basis has been pretty stable for the last 70, 80 years. And if what the US is doing with its Inflation Act and the Europeans are doing with its green energy, and Japan is doing, and China's doing, and Australia's doing, and the UK's doing, if they force enough investment in, they will change the energy source of the world. And because all of these have exponential downtrends in cost, we will change the energy coefficient. And what happens is productivity times the lowering the cost of energy is an exponential change for all of us. That's how you solve this. There's almost no other way of solving this problem of slow GDP growth, old populations, massive debts, without blowing up everything. So you're going to have to keep doing this money printing thing, which is miserable because it makes some people rich and other people poor. Or you can have inflation, which just makes everybody miserable. They're all terrible things. But the faster you can get to changing that productivity equation, the better, because it's the only way. There's simply no other way of solving it. You either rob from everybody or grow the economy.
Pal highlights the potential of AI and other emerging technologies to introduce deflationary pressures. He cautions against assuming that rising commodity prices will inevitably lead to runaway inflation. Instead, he believes that technological advancements will offset many inflationary pressures, creating a more balanced economic environment. Pal points out that people often misinterpret temporary commodity price increases as signs of long-term inflation. However, he argues that inflationary shocks are rare and usually short-lived. With AI and automation driving costs down, the long-term trend will likely be deflationary, even in the face of occasional disruptions.
Right now, we're in transition where we're not probably producing enough oil and we don't have enough energy coming out of solar, wind, geothermal, nuclear, all of that. So, we've got this market where energy prices are high because of supply issues and other stuff. But when you look at the trend, all of these are growing as a percentage share of the energy grid. There's still oil and coal are still massive, right? But they're coming down, and Europe's really forcing it, decarbonisation. And so we're seeing a rise of these others. They start, some of them subsidised, but the subsidies go over time. But the really interesting thing is none of that. It's the fact that the cost per unit of energy keeps coming down. And many of these are now cheaper than natural gas, which was very cheap. So it's like, okay. And we've only just started where we are in this exponentiality. So my view is, in 20 years' time, the cost of energy will be marginal for everybody and everything. Much like the cost of water is marginal for everybody. And the cost of many things we take for granted are totally marginal. So this is the inverse of the GDP problem. Do you manage its smooth decline, or do you blow up? Here, do you transition slowly with the issues of climate change and the issues of cost of energy and all these other things and the need for productivity, or do you blow up? Do you just take short-term pain to get to the promised land faster? Again, it's probably a rational economic decision to do that. So maybe or maybe not energy prices rise. I'm not entirely sure. Will copper prices rise? Probably. Will some prices rise? Probably. Can that be offset by AI and other deflationary pressures? Probably. It's not baked in the cake. People always conflate some commodity going up in price to see inflation's back and it's all going to run rampant again. It's very rare that happens. We've just had it now, so it's going to be in everybody's head as the boogie monster. But they're usually looking at the wrong boogie monster.
Raoul Pal concludes by emphasizing the importance of managing the transition to a more productive economy. Governments must navigate complex challenges, including high debt levels, aging populations, and climate change, while also investing in technologies that can drive future growth. The key, according to Pal, is to make strategic investments in AI, green energy, and other transformative technologies that can lower costs and boost productivity. Pal remains cautiously optimistic. He believes that if governments can manage the transition effectively, we could emerge with an economy powered by cheap, abundant energy and driven by technological innovation. However, if they fail, the result could be economic stagnation or even collapse. As Pal aptly puts it, you either rob from everybody or grow the economy, and the choice we make will determine the future of global prosperity.
Please like and subscribe my channel.